Welcome to the asset allocation stream and this session, which is all about strategic themes and tactical asset allocation. I must also welcome those of you who are joining us on the live stream. I don't think you'll be able to take in part of the live polls, but you can submit questions online. So welcome to our speakers this morning. This is going to be quite an informal session. Each of the speakers is going to have an opportunity to give you their view. We'll open up for a little bit of a discussion, and then you'll also be able to put your Q&A to them. In terms of housekeeping, as I said, you are, as in every session, you can tweet your thoughts with the hashtag PLSA Investment 19. We will be using live polls throughout the session, so please get those ready on your device, and we'll enter a Q&A session towards the end. So on the panel this morning, we have Mike Fawcett, who is the CIO of Nest, and we also have Koray Yesildag.
Very well done.
Thank you. I've been practicing. He's principal and asset allocation specialist from Aon. Now, just very briefly, in terms of asset allocation, so my role, I'm Rachel Brothwood, I'm Director of Pensions at the West Midlands Pension Fund. And I think as an asset owner and anybody in a trustee role, it's easy to get into the detail about the individual assets themselves. And quite often, you can miss some of the bigger things going on in the market, even though there is a huge wave of evidence that says that it's the decisions that are made around asset allocation that ultimately make the biggest impact and difference to the ultimate returns that you generate on your investment portfolio. And I'm sure, like myself and others, you will track, either through your investment consultant or whichever research you access, different views about different asset classes and how they change over time, with a view to informing changes you might make to your asset allocation. And over the last couple of years, that's become particularly difficult. We've heard from a number of people at conference so far. You know, the words unprecedented times, low yields, longest cycle ever. You know, I think we all know that, but what do we do about it? And what do we do differently? So the challenge really for the panel this morning is to talk a little bit about, well, what can we look out for? What are the indicators that we can really use to inform our asset allocation decisions? And actually challenge ourselves, is our menu of options that we're looking at broad enough, given the challenging times that there are with markets and geopolitical factors? So without any further, I'm going to hand over, first of all, to Mark to give us his view.
Great. Thanks, Rachel. Good morning, everyone. So we're just going to talk for a couple of minutes each and then get a conversation going. I think we're hoping to disagree on a few things to make it a bit more interesting. So, you know, as Rachel said, asset allocation strategy is the key determinant of returns. So whether you have 30%, 50% or 70% in equities is a really important decision. Whether you have 50 is your strategic benchmark, whether you have 49 or 51 in equities is very second order, possibly third order. And we would slightly challenge the notion that you can successfully add value through a lot of small tactical asset allocation decisions. Getting the big decisions right, and we might differ on timescale for that, is important. At the same time, trying to dynamically manage risks that you don't want to take is also important. So thinking about, you know, currency volatility, particularly as we go through Brexit, etc. So those are the issues that we think it does make sense to sometimes implement hedging strategies to manage those risks. So our objective as a DC scheme is to deliver sufficient growth to our members through their life cycle savings history. And for that, you know, equities are going to be a key driver. So getting that weighting right and the type of implementation is important. But also we want to give them a smoother ride. So we are looking and have diversified successfully into a range of other asset classes. And in particular, you know, everyone's talking about illiquids in DC. So we are on that journey of investing in alternatives. We've got property in the portfolio, and we're just in the process of appointing a number of private credit managers. So getting some of that, you know, very different characteristics of those different asset classes is important to make that smooth journey and also get some other opportunities. And in the nature of those opportunities, we see ESG integration as across the asset classes as creating a way of not only managing risk and improving risk-adjusted returns, but actually there will be some opportunities there. So if you think about the transition to a low-carbon economy, investing in infrastructure, debt and equity, in terms of renewables, wind power, solar power, etc. That's a real opportunity which we think is important. We see a lot of managers paying lip service to ESG. It's on everyone's lips. You get invited to an ESG conference every day, but actually true integration is a way of managing risk and seizing some of those tactical and strategic opportunities. So I wanted to wrap up there. So the asset allocation's the most important decision. You need to manage the risk. We believe you need to diversify and thinking about the diversification into ESG as well.
Thank you, Mark. Particularly pleased to hear you talk about ESG, and we'll explore that a little bit later in the Q&A. Koray, over to you.
Thank you. Yes. Just a brief introduction. I work in the global asset allocation team with Aon, and our team basically is one which is central to a lot of what the Aon investment process is. So we provide our views to the delegated side, our delegated teams, the advisory consultants, and also we work closely with manager selection as well. And I'd like to sort of echo what Mark was saying in terms of how important asset allocation is, but also slightly depart in terms of some of the timescales and how we see the value add of some of our different decision making. So from a strategic perspective, asset allocation for us is certainly the most important decision you can make, how much you want to have in the different asset classes. However, we do one of the main things we do provide is a medium-term view. So what do we mean by medium-term views? Well, we're talking about views over the next 1 to 3 years. So certainly not tactical in the traditional sense in terms of sort of the next 1 to 3 months. None of that kind of really sort of short-term trading, which really isn't very appropriate for pension schemes. But not simply saying we've set our strategic allocation and that's it, we're going to run with it. We have found, our work has found that there is this sort of sweet spot in the middle where you can make some sort of not strategic, but more sort of leaning towards the tactical tilts. Moving around the regions in terms of equities, maybe becoming a bit more defensive in style, thinking about different asset classes and when to introduce them, when to reduce them. Those kind of things can really matter. So I guess what Mark was saying in terms of managing risk, this is one way that we certainly manage those risks. And Rachel was talking about how we're in a very difficult environment. It's a world of low returns. It's what we like to call a transition environment from a period when market returns were consistently positive to a period when market returns will be consistently negative, but we're not there yet. So it's going to be one of these much more volatile and difficult to predict periods. So for that, we think that our sort of medium-term views, our asset allocation decisions on that slightly shorter-term time frame really can add value. So with that, I'll just see where else the conversation takes us.
Okay, thank you. So I think we need to get into the detail a little bit more now, and we're going to start that by turning to our first poll question. So if you can have a look on your app, and you'll see on the screen now. So have a think. Which equity region do you think will perform the best this year? Let's see what sort of views we've got in the room. Give it a second, don't want anybody cheating. Okay, let's have a look at the results. Okay, still moving around a little bit. US and emerging markets can't be split at the moment, but definitely not Europe and UK. Oh dear. Okay. Mark, any comments?
Yeah. Well, my first comment is we try not to take a view on the different regions in developed markets. So we want to have a very clear view on developed versus emerging, and I think we're probably, I'm in danger of agreeing with a consensus here. I think we view emerging as probably the slightly better opportunity. I would say, the US is a very dynamic economy, and has proven time and again that it can carry on growing strongly. We see some risks. We don't think it's going to go into recession, and so that would kind of support the view of the market will carry on doing okay. But we see the risks of recession around trade wars, around sort of anti-immigration policies, but the sort of things that have really driven growth in the US. But there's clearly some friction there potentially. Aon have got a big US presence, so I'm sure you'll have a lot of interesting views on that.
Yes, well, I think just in terms of the commenting on the poll, from a medium-term perspective, next sort of 2 to 3 years, we would definitely agree that emerging markets are a good opportunity. However, I think we've got to be a bit careful over the next year or so. I think it's a very volatile period. So we know that emerging markets have actually done quite well over the last few months. A lot of this has been related to a bit of a step back in terms of the pace of monetary policy tightening by the US. The dollar sort of being not necessarily weakening, but certainly not appreciating as much anymore. And as we know, emerging markets tend to do well when the dollar is weaker and when interest rates are not rising. So those things are clearly in train, but at the same time, we have to be careful about the US in terms of where it's going. So yes, I do agree that we're not going into a recession anytime soon, but I think the risks are higher than maybe Mark has alluded to. I think the two elements that we haven't mentioned is, as I said, monetary policy. The direction of travel there is towards tighter policy. We've had a bit of a slowdown in the rate of that, but I think tighter policy is coming from there. And the other one that we certainly haven't mentioned is fiscal policy, which is going to be tighter. Now, if we remember last year, right at the beginning of last year, we had these really big tax cuts in the US, which very much boosted the US economy and the US markets. That really did help. But with the change in guard in the House of Representatives, now we've got a split political picture in the US. A lot of those tax cuts are going to expire. They're not going to be renewed. There's not going to be many more of those. So you're getting less fiscal policy support, less monetary policy support. We're at the end of the cycle. Growth is slowing down. And while I agree that recession isn't coming, I wouldn't be surprised if the markets are surprised in that we do get something. The risks do rise as you get closer and closer to the lower bound. In terms of Europe, including the UK. I think the UK we might talk about later on in terms of the dreaded B word. And when it comes to Europe, there's a lot of issues there in terms of the political issues, and Italy is already in recession, for example. But be careful here as well, because the European Central Bank have already started talking about opening the monetary policy faucet again. Sorry for using your surname.
Different spelling.
I didn't mean it that way. But so increasing the monetary policy support might mean that we could be surprised by European performance over the next 12 to 18 months, simply based on that kind of support. It's not our core view, but it's something to keep in mind, I'd say.
I guess one point I might argue with on the US is I think the Fed is very cognizant of the fact that if it over-tightens or tightens too quickly, it will send the US into recession, particularly bearing in mind the fiscal position. And I would say they probably wouldn't have just tightened in December had Trump not made such a big thing about they shouldn't tighten. And it was an assertion of their independence rather than actually we really need to raise interest rates again. So I think they probably stop for now, and again, that would support our sort of view on emerging markets.
Yes, I think that's a very valid point. The only thing I would add to that is that given the decade-long, very low interest rates, incredibly accommodative market conditions we've had, and the fact that lots of markets have really just made hay from that, I would say, and this is hard to test, that markets are a bit more sensitive to the level of interest rates. You might not need to tighten as much as you think to suddenly be over-tightening. Sure. So it's a bit more sensitive. Yeah. I do agree that they probably stopped for now.
Yeah, and then the other risk is just tight capacity in the US and inflation potentially building up, which would force their hand somewhat.
Yeah, so you're stuck in this position of, do we chase the inflation or do we worry about the end of the cycle? Yeah.
And the political dynamic, which I think we've heard about throughout the conference really, is creating a sort of an interesting change to perhaps some of this regional preference that it might have done otherwise. But I'm conscious we could go on for a long time about this, and there's lots to talk about. So let's move on. Second polling question, if you could turn to, please, and this is quite apt given the couple of sessions that we have had this morning in the main auditorium. Why are you investing in ESG? Right? Some of you might not be. I think that's what we may have learned this morning. But if you are, what is your rationale for doing it? To enhance returns, reduce risks, be ethical, to affect change in companies, or to help combat climate change? Views, please. And if we could have a look at the results as we go on this one, it might help. Great. So it's all about risk and return. Excellent. That's the fundamentals of asset allocation. Yeah. Mark, this is an area you spoke about. Sorry.
Yeah, no, I didn't want to hog there. So I would have struggled to answer this because it is about improving risk-adjusted returns, I think, as I've already alluded to. So primarily, we get our managers to look at ESG risk and manage ESG risk, but increasingly, investment in renewables, etc., investment in social housing actually create some opportunities to enhance returns and be a sustainable and responsible investor. What I would say is it's got nothing to do with ethical investment. Ethical investment is about values, and this is about creating value. So it's not about eliminating arms or tobacco or whatever. Those decisions, we have an ethical fund which does all that, and it's performed really well. But for us, integrating ESG is right across all our portfolios.
I think that's one of the confusions that we come across quite often is the sort of the ethical angle versus the sort of more pure ESG angle. So, some people have quite validly said, if you are investing in equity indices and you just remove the tobacco and the arms and all those kind of companies, you're arguably removing some of the most profitable companies in that index. So actually, are you enhancing returns and reducing risk? You probably aren't. So, and then there are other examples. So, for example, green bonds. We've done quite a lot of work on sort of researching green bonds. Now, you'd think, those kind of fixed income investments that are linked to more green initiatives and more sustainable initiatives are good things. But then, when you look at it, quite often it's a labeling exercise by parent companies that aren't actually that ethical or sustainable. So you have to be very careful about the marketing. Some of this stuff is just marketed towards being ESG or ethical and those kind of things. And actually, when you dig a little deeper, they're not that. They don't enhance returns, and they don't reduce risk. So you've got to be very careful about that. I think that's what I would caution here.
And I absolutely agree. On a product side, it's very important to have a look under the bonnet. But that segues nicely into some of the questions that are coming through on the app. So just a reminder, you can submit questions through the app. We'll take a few from here and then open up to the room for any further Q&A. But one of the first ones, and thinking about what we said at the start around asset allocation rather than individual products, how can pension funds and investors incorporate climate change considerations into asset allocation decisions?
Shall I? I'll begin with this one. Yeah. It is very difficult. I think that's the short answer. The slightly longer answer is that you need to look into, look at funds that might be more active in terms of sort of being more active investors, affecting change in the large companies, looking at certain types of infrastructure investments. But then with those, you have to worry about, and I think this is something we might talk about later on, especially on the DC side, the illiquidity. So that's not always going to be that appropriate for DC schemes. And there are ways that you have to manage that and think about different formulations for these kind of investments and asset classes. So it's sort of looking at the ultimate aim, looking at the ultimate results, It does require a much higher governance burden, though. It isn't as easy as equities versus bonds anymore, and I think that does make the challenge for investors and schemes that much higher, I'd say.
Yeah, so we invest in a climate-aware equity fund, which has systematic tilts towards renewables, away from heavy carbon emitters, towards companies that have a clear transition plan to a low-carbon economy, and those sort of products are becoming more popular with providers, so it is a chance for pension funds to allocate. I think just divesting carbon is not a good way to go about things. We know that using carbon is going to be a major source of fuel for the next decades. It's a question of how you transition. So being systematically underweight, I'm going to say, for example, ExxonMobil were underweight. They're not one of the best companies, oil companies. There are better oil companies when transitioning, but we remain shareholders. We engage when we vote pretty systematically against management on issues in order to improve them. So, one of the questions, why do you invest in ESG? To improve companies. We need the bad companies to get better as well as the good companies to lead the way.
Yeah, I fully agree with that. I think the thing is to affect change. If I had to vote in that, I would say to affect change within companies. And you've seen the results in some of these companies already, and I think that's the way to go.
And I guess thinking more broadly about risk and ultimately what we're trying to do, which is achieve the best risk-adjusted returns, what would your advice and views be at the moment around where you'd go to find that value add in the context of the current climate?
We are starting to move into private credit. There's a lot of dry powder in private markets, and you have to be just a little bit wary of that, so you don't rush in. But there is, in our view, still an illiquidity premium. So the spreads on investment-grade corporate bonds are really pretty low at the moment. But if you can invest and you've got appetite for illiquidity, then you can invest and get an additional premium. Private equity, again, might be quite interesting. Again, there's a lot of dry powder, but over the long term, you get often better corporate governance in private firms. And at the same, over the last 20 years, the number of listed companies in the US has halved. More staying private for longer. And so if you want exposure to, the world's largest and most dynamic economy, you probably have to go and think about going into private equity as well. Albeit, I hate the fees, and we probably don't have time to discuss that, but that's not a surprise to anyone, I expect.
Whole of the session.
I would pick up on one thing about the, you mentioned the illiquidity premium. I think from my perspective, that's a bit of a red herring in the sense that it's not, what I would say is it's not a premium attached to simply being illiquid. For me, you don't get a premium simply because you lock your money away for a long period of time. I think that comes along with certain investment opportunities which happen to lock your money up for a long period of time. It's a different way of looking at it. So it's not the sense that, this is a long-term investment. It's one that we will phase in over a number of years, and we're really going to see the results in a number of years. It's more, is this investment actually inherently a good investment? Is this investment actually going to be achieving the kind of returns that we want and lowering the risk that we want? Illiquidity is secondary, in my opinion. Obviously, it might be a different case when you're talking from a DC perspective. But.
No, I agree with you up to a point. It's illiquidity and complexity to some extent. It is the nature of those investments that generates the return, and you are locking your money up. So that's fine. I think where you really earn your illiquidity premium is when markets are stressed. So we saw in 08, 09, actually previously very liquid investments or fairly liquid investments such as corporate bonds became very illiquid. Anyone who was prepared to provide the capital and could provide the capital and could get trustees to sign up to, we're actually taking on more risk here, earned very handsome rewards as a result. So that's when you really earn that illiquidity premium. It's very hard, it requires bravery, but it is kind of pertinent to this session, because if we get a market stress event in the next few years. It's likely to happen at some point. That's when you've got to have the courage to step up and say, I'm going to commit capital to, because everyone is trying to get out of this.
And I guess this is part of the way in which you can diversify some of your allocation to your growth assets. And even that is challenging in a context where the correlations between perhaps those assets are changing and are difficult to measure. Is that something you'd like to comment
I mean,
on?
I think that's the core of my slight challenge about the illiquidity premium is that what we like to say is that, okay, so we're in a transition environment where it's a world of low return, so relative value makes much more sense than absolute value. And when we're talking about illiquid assets or diversifying assets, we say look for asset the patterns in returns to be quite different from the gyrations of equity markets. You reduce that correlation, improve your diversification, introduce some degree of risk mitigation, downside protection when you can. So that's the way we look at it, and then we say, well, some of these are illiquid assets as well. So think about that when you're deciding on your assets. But it is unavoidable that there are going to be periods, especially very stressed periods, where what you think is a very nicely diversified portfolio that's going to really weather all the storms will see all these correlations, all these links tend towards being very closely correlated all of a sudden. And then you're in this position where you think, actually, nothing is bailing me out here. You might, for example, hedge funds. Some hedge funds you might think on the packet are going to be really quite defensive. They're going to really help you out. Trend followers, for example, they tend to not have very close correlations with equity markets. But when the equity market stresses, if we get a really sharp sudden fall, actually lots of trend followers fall really quite sharply as well. And those guys actually help you more in a sort of long-term soft downward trend rather than a quick sudden, it's those kind of really sharp, difficult periods, short periods, where you have to decide, is that the beginning of something that's going to mean that we're not diversified correctly anymore, or is it just something that's a blip that we have to live through to get to what those diversification benefits are? Our work shows that over the longer term, so medium to longer term, 5 to 10 years, diversification absolutely helps. But in the shorter term, any kind of given 6 months to 1 year period, it might not work. So that's something to keep in mind.
Thank you. We've had a very good specific question come in on the app, so I'm just going to flick to that. So given Trump's desire for re-election, is there a longer window for risk assets, as any slowdown is likely to be met by further fiscal stimulus or pressure for monetary stimulus, as we heard, into 2020, an election year?
Shall I? You go
I'll
first.
take the poison chalice.
I have some thoughts. But
I certainly have some thoughts as well. I think, as I mentioned before, Congress is split now. The Democrats are almost certainly not going to agree to any kind of fiscal spending, which helps the Republicans and Donald Trump's re-election campaign. So I think the chances of any extra fiscal stimulus, even if the economy weakens, is very limited now. There are even fiscal hawks on the Republican side. There are people who are not very strongly pro-Trump on the Republican side, but they do want to see debt levels come down, or at least not rise as quickly as they have been. So there's just no support, in my opinion, for fiscal support. On the monetary policy side, I think that's independent. I hope it's still independent of any kind of political meddling. And if the economy does start weakening quite sharply and inflation isn't rising, then I could easily envisage the Federal Reserve, increasing monetary policy. That might help a bit, but I don't think it's going to be a game changer. I don't think it'll change things fundamentally.
I broadly agree. I guess the Democrats won't want to appear to be blocking sensible policies which will help the economy. So the wall is a classic. That's clearly not a sensible policy.
I thought it was
so they can. My partner's half Mexican, so she doesn't like Trump any more than I do. So it's. They can easily block that and that be sensible, but at the same time, the Democrats tend to be more fiscally loose than Republicans. So I think if the right sort of spending came up, they might be supportive. The Fed typically has been very cautious in election years about tightening monetary policy. They don't want to seem to be sort of effectively influencing election outcomes. So I imagine they're going to be quite benign.
And I think the thing with the, yes, that's true that the Democrats tend to be more fiscally generous, shall we say. But just with all this talk of the government shutdown at the turn of the year and everything, I think the real problem here is that the dynamic has changed between the Democrats and the Republicans, where it's become much more adversarial. We all know this, yeah. And it means that if there is any kind of policy that comes to the House, then it might have strings attached, which might become unacceptable. So, for example, we will do this new road and infrastructure sort of initiative if you give me more funding for military or the wall, and then you get into all sorts of complicated arguments.
And the US is crying out for more infrastructure spending.
Absolutely.
You know, it's falling apart. So.
And that's actually a question we've had in terms of infrastructure as a sector, globally or in the UK, do you see this as an asset class that pension funds should be looking seriously to include within their portfolio?
I'd say absolutely. Well, I mean, in my case, for DC funds. So, you know, our youngest member is 16 years old. They've got potentially a lot of illiquidity appetite. So, Koray sort of talked about, you know, there's some potential challenges about getting illiquids into DC. But this is the sort of thing we should be investing in rather than worrying about, you know, the ticks of shares on a daily basis. For DB, you might have a...
No, I think from the DB side, infrastructure spending makes sense as well. Again, it goes into our sort of asset allocation theme of reducing the reliance on equity markets, diversifying. It certainly is a long-term trend. There's, you know, it's not just the US that's crying out for huge infrastructure spending. I think the problem might be, again, you've got to be very careful here because some of these infrastructure projects are very politically sensitive. Some of them do run into questions of sustainability, questions of ESG and all those kind of things. And they all start getting wrapped up. And there is the risk of delays, cost overruns, even cancellations in some periods. So you got to be careful. It's not a free ride either. But certainly we would be recommending the right selected types of infrastructure investment.
Yeah, and if you look at the big Canadian pension plans and the Australian super funds, you know, they've got very significant infrastructure investments, and that's worked really well to their advantage. But you've got to go with your eyes open.
Mm-hmm. Yes, I agree.
And I think continuing that theme is of looking at perhaps opportunities in for DC schemes versus DB schemes. Are there any areas where you think perhaps for one product or investment you see different opportunities? Is there a different opportunity set in the DC space than there is in DB?
Well, given most DB schemes in this country are closed to new members and new accrual, you know, they are on a de-risking path to buyout or similar, whereas we and, you know, all the other big DC auto enrollment schemes have got a lot of appetite for growth. We need the growth, and we need to find the sources of growth. So I think, you know, we alone will be taking in £4 to £5 billion a year in future years of new contributions. We've got to put that money to work, and it doesn't seem to make sense to me that we just stick it all in equities and hope for the best when there's a lot of good diversification opportunities which can actually deliver more stable growth.
Mm-hmm. Yeah, I think it is, you know, from a DB perspective, a lot of it is about managing towards buyout and flight paths and things like that. So some of the things we've been talking about recently is cash flow driven investments and, you know, matching liabilities, matching cash flows and those kind of things. So, you know, de-risking tends to make more sense there. We would certainly say that from the DC perspective, at least over the next year or two, some degree of de-risking or at least diversification makes sense as well. But certainly it is a different mindset. It's a different cohort. You know, as you said, some of your members are still teenagers and very young. By the time they reach what we think now is retirement age, will they really retire? What will be the retirement age? Is there a real concept of maturing funds anymore on the DC side? I'd say no.
Certainly less than it was, because now people don't have to buy annuities. So our glide path has altered, and at some point, we'll hopefully be giving people retirement income as well when they choose to retire. And the nature of retirement is changing as well. People go part-time or go back to work, etc. So you need a lot more flexibility at the mature end, if you like, and you still need some growth, and you still need to be generating an income.
Yep.
So it's less like an individual DB plan in some senses than
absolutely. Yeah.
Maybe Michael.
No worries. Well, we've got a few minutes left, so I did want to say if anyone's got any questions in the room they'd like to ask. There's a couple left on the app, but hands shooting up straight in the middle there. I'll take a... You could say who you are, that'd be great.
Thank you. Louise Howard, I'm the Chief Legal Officer at USS. So I would just like to pick back up on the infrastructure theme, if that's okay, quickly. I've spent a bit of time with Canadian peers, actually, in recent years, and they were talking about the fact that the market's getting quite saturated already in the infrastructure area. They themselves, and also long-term private equity, starting to be a big sort of competitor. Given that's already what I'm hearing in that, and we do a lot of this type, they were talking about the need to start trying to find infra, which isn't quite infra, but it's got enough of the characteristics. So if already the people that were in the market are already scrabbling around, which was a phrase they actually used, if we take too long in the UK, particularly in DC, to find a way to access, heeding all the warnings about it being quite a spicy area, are we just going to completely miss the mark altogether?
In the short term, I think there's a real risk that you end up overpaying because there is so much money chasing these assets. I think over the longer term, that's less of an issue. I mean, Canadian Pension Plan and Ontario Teachers, who have kind of been groundbreaking in this area, they've got such large assets, they need really big infrastructure investments. What we're hearing from managers is actually, if you've got smaller ticket sizes, you can find some niche areas which are just too small and too insignificant for the big managers. USS might be a big manager as well. So, I think the opportunities exist, particularly for smaller schemes. Well, obviously, we're going to be a large scheme, but our allocation to illiquid assets is always going to be smaller than the big DB schemes because primarily cost, but also we do need to manage illiquidity to some extent.
Yeah, I broadly agree with that. I think your question is quite right, but it's also looking at it from the perspective of what's the current opportunity set, what do we have on the table right now. And from that perspective, I think the opportunity set is more limited. It's more difficult. A lot of people, this isn't the first time in any conference around the world we've been talking about infrastructure. We've been talking about this for a long time, and a lot of investors have already gone down that route. But the opportunity set will change over time. There will be, despite what Donald Trump might be doing in terms of closing the Environmental Protection Agency or that kind of stuff, there is a very strong trend towards changing the infrastructure, not just updating it, but improving it in terms of more sustainability, more technologically aware, future-proof. Those kind of projects will start coming on stream, and then we'll see other opportunities come again. So yes, we might be late for this opportunity set, but there will be more, I think.
Yeah, I mean, UK is going to be apparently 30% of power by 2030 will be generated by renewables. Another 30% will be gas powered with carbon capture. Mm-hmm. All these things need investment, and the government clearly can't do it all.
Yes.
Thank you very much. We've covered quite a range of topics there, and we are reaching the end of our time. So we're going to draw that to a close. I'm sure the guys will be around if you do want to ask them anything more immediately afterwards. Just in terms of what's happening next, there is lunch in the exhibition hall, and then at 2:15 there is a learning hub session on the outcomes of the CMA review. So feel free to join that. In the meantime, please join me in thanking our speakers, Mark and Koray, and you for your questions.